Hey, it's Damian Piotto here from living in Brisbane, and here is the best news for a lot of borrowers coming through. Relief is on the way. Fresh signs interest rates have peaked and the tide is turning with inflation. Look, borrowers have received the strongest indication yet that the Reserve Bank's rate hike cycle is over, with eyes now turning to timing of the first cut. And why that's important is that Wednesday, there's highly anticipated inflation data coming out, and it's probably going to indicate a sharp slowdown in CPI, so Consumer Price Index, which was happening in the December quarter. Now, it takes the annual rate of inflation to 4.1%, and why that's important is that it's its lowest level of 2 years, down from 5.4% annually in the September quarter. As well, it's below the RBA's forecast, which was 4.5%. Guys, just a quick heads up, inflation peaked at 7.8% annually in December 2022. So trimming that inflation number, it strips out that volatility in changes, and it's potentially going to be softening the highs and lows of what's been happening in the marketplace in the last 2 years. But guys, let's jump ahead and see what rates are predicted to start falling, okay? Over the quarter, the biggest contributions to inflation were things we probably already know about: housing, encompassing new construction, rent, utilities, alcohol, tobacco, a big one with insurance, financial services, and food. Look, one of the best thing about statistics is that there's a lot of information out there, but what we're being told is that with the higher labor costs and material costs contributing to price rises, especially around housing and construction for dwellings, it means that new housing is slightly higher than normal. And what that's doing is that that's putting a bit more pressure on people's ability to build. And we do know with new constructions that it's vitally important to accommodate everyone that's moving to Brisbane at the moment, and people looking to do more in and around the area as well. Look, over the past 12 months, insurance rose about 16%, making it en masse the largest annual rise since 2021. When you see these big increases, it makes you think, and I'm going to do a video about this, about choosing your right insurer, and that was just a quick tip for you as well. The other thing that's really important that people are talking about, and senior economist from PropTrack, Paul Ryan, and I love to get his information, is that when it comes to rent, is that it's been extremely high over the last couple of years. So measuring rental increases would have been even larger if the Commonwealth didn't have limitations on how much you can increase your rent, and rental assistance as well. It just goes to show how tough the rental market is, and with PropTrack data and advertising rents showing for some time, is that there's been a very big increase in rents over the last 2 years, almost a third. So if you think about what your rent was 2-3 years ago and it's gone up 30%, that's quite significant, okay? So this is putting financial pressure on a lot of families, and they are suggesting it's easing into 2024 and 2025. So this will slow potentially the price growth, and investors probably won't be too happy to hear that, but they've had a good couple of years. But it is welcome news to households feeling the cost of living pressure. Look, it comes a day after rental trade showed that it had been pulled back over Christmas, and especially what's really interesting is that time of year when we start with shoppers and Black Friday sales, seeing that reduce from the increase gives you a bit of an idea of what's happening out in the marketplace, and people are a bit more savvy with what they're doing. And look, shoppers are spurred on by hearing those different things that are happening, especially around only buying when there's good deals on and not just spending when they need something. So look, sometimes it's a bit of an ambiguous picture when it comes to spending, because we are in a 3-month lag when it comes to these statistics, but the pullback is kind of expected. The consensus forecast is that there was a milder decline across all types of shopping and investments into those type of things. So about 2%, which if you think about GDP, that's quite a significant amount as well. The other thing that I wanted to quickly talk to you about is that the slowdown signals rate cuts are on the horizon. Why is this important? Is that a string of soft data all but confirms the RBA, which will meet in February, will remain on hold, and they're meeting for the first time this year. So here's the prediction, okay? Financial markets are pricing almost no change in interest rates in February. So they're saying it's going to sit in place. Now, with the first cut projected in September, economists at the major banks are also expecting the RBA's next direction to be down. With CBA and Westpac forecasting their first rate cut in September, while NAB and ANZ also anticipate their first move in November. Now, we all know they probably won't pass on the rate cuts to us, and of course when they go up we get all of it, but that's a story for another day. Beyond this year, interest rate forecasts widen across all the four banks, meaning that most banks will see the cash rate sitting between 2.85% and 3.6% by the end of 2025. There are some predictions that because the slowing inflation may force the RBA to cut rates as early as June, which I think a lot of people who have properties that have come off a fixed rate are happy to hear. Now, the sharper than expected fall in inflation means that the RBA's inflation forecasts are looking a bit hawkish. So what we're talking about is that predictions that potentially were coming up, there's a bit more volatility in the rise, and it's really something that we need to be thinking about, is that there's big global longer term risks when it comes to things like shipping supplies, assuming that inflation resolves a lot of the projected problems that potentially come with that. And it's a year earlier than the RBA projected when it comes to rate cuts and things like that. But the shorter term inflation momentum means that the growth is going to be quite weak when it comes to new borrowing and people refinancing based on some of the measures that the banks are talking about. So it'll be interesting to see what people's opinion is and what they'll do with potential rate cuts in mind. So interest rates have likely to peaked. It's put a lot of stress on borrowers, and interest rates have also come with a certain amount of stress for borrowers. So with the RBA expecting to have cuts, like I said, potentially from June and holding in February, it's likely to mean for borrowers that with the bulk of fixed rates for borrowers having rolled over already, households have seen a steep increase in mortgage repayments, and that's something that people need to look at. And I'll show you the graph as well that talks about how much that's gone up. Now, if that goes on hold, that's quite a good sign, because it means that we've had 13 rate rises since May 2022, and it's been quite a distinct curve for people. Okay, so variable rate borrowers who haven't refinanced and have seen their mortgage repayments surge by sometimes up to 60% in the past 18 months. And again, I'll show that picture. People who are looking at fixing potentially might be on the cusp of waiting just that little bit longer to see if those variable rates do go down. And quick tip, guys, if the banks start offering really attractive fixed rates, that could be, I'm not saying it's an exact science, it could be a sign that interest rate cuts are projected to come, and they're trying to lock you in at that higher rate that looks attractive after seeing 13 interest rate hikes as well. Look, and how much are the predicted rate cuts going to save borrowers? I do have a calculation that I'll show here now, and it's assuming the borrower is an owner-occupier paying principal and interest on the property on a 30-year loan. It's important that those type of variables go through from there. And again, interest rates are as high as 7% at the moment. And when we had our really low interest rates, some of us were getting interest rates at 1.99 and 2.07. So all those things come into play, which is quite important. Guys, just finally, there's always the option when it comes to mortgage stress and what's happening at the moment, is that property prices have been risen every month since January 2023. So if you are in a position where you can't refinance and you've got a little bit of stress and potentially you want to be able to pay out that loan and buy something a bit more affordable to fit your lifestyle, selling your property in this market is a good idea, because it might take that bit of pressure off the household with having a bigger loan. Potentially people talk about being a bit more entrepreneurial as well. And what that means is that trying to find a second or third source of income while doing their main role moving forward. Look, finally, mortgage arrears, albeit published with a lag, remain historically low. And you might want to be thinking about, why is the mortgage arrears so low when we've had so many increase in interest rates? Is that the resilience in the labour market and low unemployment has provided a good safety net. And that's kind of a driver why mortgage arrears have historically been low. So what that means is that there's more money to float around, and obviously people are going to prioritise their property over anything else. So while many households may be feeling stressed about spending and they've made the adjustments as they need to, they've continued to prioritise their repayments and reducing spending elsewhere. Look, increased work hours and drawing on existing savings is something that people have done as well, and it just makes sense with the projected rate cuts that hopefully that just takes a little bit of pressure off people, and what that can do is really help them moving forward with some choices and give them that buffer that they had in the past. And guys, as always, when it comes to real estate and anything around buying and selling, you can call Damian Piotto on 0455 986 093. I'm always happy to help you with what your needs are, take some time out and try and provide you the service that you deserve as well.